A quick question in your Intro to Finance course. How did you work out non-GAAP net income plus is advisable to use non-GAAP or GAAP? Why constructing a model? Yeah, but the question is on GAAP versus non-GAAP. And so in the United States, there's a tax code that says that you have to report taxes in what's called GAAP. And what GAAP means is when you're recording your income statement, for example, you're going to list all items, everything, including stuff that's not cash. And I'll show you. Hold on. With an income statement, we start off with sales. Okay, sales goes on the very, very top, right here. Yeah, sales goes on the top. You know, a lot of times people will say, "What's your top line?" Well, top line is sales. Sales is at the top of the income statement. And the bottom line, when people say, "What's your bottom line?" That's net income, which is on the bottom of the income statement. Okay, so sales goes in the top. Then what you do is you're going to account for the cost of all that stuff you just made. Okay, it's called cost of goods sold. Then what you'll do is below that, you're going to put sales and marketing. That's an expense, right? You hire salespeople and you pay for marketing stuff to market your products. Then below that, and I'll get to the GAAP versus non-GAAP point in a second, okay? Then below that, you've got G&A, which is general and administrative. And by the way, when you're making your income statement, if you have no idea where something goes, just throw it in the G&A bucket. Okay, and I need one more over here. Research and development, which is right here. Okay, great. Research and development. If you have interest, income, or expenses, you'll then add or deduct that. Then what happens is you then deduct depreciation, okay? And that's key. And then on the very bottom there, just assume that net income is on the very, very bottom there, okay? So what I just showed you here, this is GAAP because it accounts for all expenses, okay? Even if they're not cash-based. Say, what? Well, depreciation basically means this. Let's say I have, I bought a machine. This machine has a useful life of, say, 2 years. Then what I can do is every year I can expense 50% of the cost of this. Okay, and that goes into what is called depreciation. And it's a beautiful thing because if you deduct an expense, you depreciate every year, then you're going to pay less taxes, right? Because taxes basically is based on all these expenses. So sales minus all these expenses. So depreciation is an expense. Therefore, you're going to pay tax on a lower amount. Okay, that's depreciation. And that's GAAP. This is GAAP right here. Okay. Now, it's not really reflective of how much cash you're going to get in your pocket, though, because depreciation is just it's just a funny accounting term, right? So that's GAAP. Non-GAAP is more simplified. Non-GAAP gets rid of depreciation because it's not a tax. It's not a real cash expense. Like every year, I'm not paying an additional dollar amount for this. I already bought it ages ago. This here is non-GAAP. Okay. And everything you see here is a real expense. Depreciation is not a real expense. Hi, I am not a real expense. So that's the difference between GAAP and non-GAAP. So when you think of GAAP, think of it's not really a reflection of the increase in cash I'll get in my pocket. When you think of non-GAAP, I want you to think of, okay, it's kind of like, it's more intuitive, cash in, cash out, how much cash can be in my pocket, and we don't account for non-cash items like depreciation. So hopefully that's helpful.